Hello, everyone. This is Sam Zakarian again. Today we are going to do chapter 10. Today's session's on chapter 10, which is on page 128 of your 10th edition of the workbook. So let's get to this right now. This particular chapter deals with the closing of real estate. Now, on the very first paragraph, buyer has certain requirements to close. They include those bullets over there. They want to make sure that they get the evidence of the title. They want the seller's deed, any documents demonstrating the removal of any undesirable liens or encumbrances. They want a copy of the survey, results of any required inspection, and if there's any leases on the property. Now, final property inspection, you can highlight that paragraph. This is a day before the closing, we have what's called a walkthrough. This is where the buyer walks through the property to make sure the property's in the same condition when they first made the offer on it, less any ordinary wear and tear. Spot survey, you can highlight that paragraph that was discussed before. Survey will show if there's any encroachments on a property. Now, seller has certain requirements to close that next section. Seller's requirements is basically, was the buyer able to get the funding for the property so they could close? That's what the seller's concerned about. Okay, now let's flip the page. Let's actually I'm going to skip page 129. You can go over that on your own. Let's go to page 130. Face-to-face closing, about the middle of the page. Now they call this a face-to-face closing because this is generally when both the buyer and the seller meet each other for the first time and they sit across the table from each other face-to-face. That's where you get the face-to-face closing. The next paragraph, closing agent or closing officer. Now, at the closing, there's usually one person that conducts the closing. She's the one that sits at the head of the table. Usually on the right, they have the buyer's attorney. Next to the buyer's attorney, they have the buyers. Over on her left, they have the seller's attorney. Next to the seller's attorney, they have the sellers. And the real estate agent's also sitting at that room as well. Now, the closing agent, closing officer, closing agent, she doesn't represent the buyer nor the seller. If she represents anyone, it's going to be the lender. Make sure the lender's interest is protected. And then when all the documents are signed, the exchange is made, the buyer gets the deed, the keys to the property, the title to the property, and the seller gets the check. Let's go on to page 131 right now. On page 131, closing and escrow. You can highlight that one. We call this a dry closing in the real estate business. Now, closing and escrow, maybe they're missing a document. Maybe they didn't get the certification for the zoning. Maybe the money wasn't wire transferred over. So what they do, all the documents are signed and they're placed with the closing officer, but nothing's going to be distributed. The money, the title, the keys, nothing's going to be distributed until they resolve this one issue. Now, usually this would never take more than 24 hours. Now, the closing, escrow closing procedure, actually you could go over that on your own, and also the bullets underneath for the buyer's deposits and what the seller deposits on there. You can go over both those things, those bullets on your own. Now, let's go to page 132. The last couple of paragraphs you can highlight, put X's by it. The licensee's role at the closing. Generally, there's two main reasons why a licensee shows up at the closing. You know, they want to ensure that everything goes well, and then they need to make sure they pick up the closing check for their sponsoring broker and the closing documents that tells how the money is going to be prorated, which I'm going to talk about later on in this chapter, because this closes out the file. They cannot get paid until they have all the closing documents and a check from the title company upon the closing of the transaction. Now, let's go on to page 133, second paragraph. Lender's interest in the closing. You can highlight that. What the lender's interested in is making sure that their interests are protected. They want to make sure they're using the property as collateral. They want to make sure that all the documents are signed, the loan agreement, how much they borrowed, how much they're going to be paid um, over the course of the life of that loan. All that's going to be on there. Now, a couple of paragraphs down where it says Real Estate Settlement Procedure Act. I'd like you to highlight and put an X by the next two paragraphs, and also you can highlight all the bullets on the bottom. Now, this is called the RESPA, Real Estate Settlement Procedure Act. This is the very last document signed by both the buyer and the seller. It's usually a 4-page document, has all the expenses for both the buyer and the seller, how much money the buyer needs to come in with, how much money that the seller is going to net out. Includes everything that's going to happen, like the fees, the accounting fees, the recording fees, the attorney's fees, the title fees. All those things are going to be part of the RESPA form. RESPA is always required whenever there's any financial institution involved, any bank involved in this. Now, this on top of page 134, the first 3 bullets, I like you to highlight, put an X by it. Now, there are certain requirements required by RESPA. It says on the very first line, RESPA prohibits certain practices that increase the cost of the settlement services. The first bullet, and put an X by all 3 bullets. Section 8, and you don't have to memorize the section numbers, but I just want to go over these with you. Prohibits any type of kickbacks or fee splitting for referrals of settlement services and any unearned fees for services not actually performed. So the thing is, can you take a kickback? The answer is, well, you can take a kickback. You're allowed to take a kickback as long as it's disclosed and it's not charged back to the client. And it can't be paid directly to you. It has to go to your sponsoring broker. Then your sponsoring broker will pass that on to you. A kickback is where, maybe it could be a loan company, a loan officer, maybe a title company, maybe a home inspector, an attorney gives you some money for referring that business to them. So kickbacks are allowed as long as it's not charged back to the client. You disclose it in writing to all parties involved, and it's not paid directly to you, has to go to your sponsoring broker. The very next bullet, where it says Section 9, prohibits home sellers from requiring that the home buyers buy title insurance from a particular company. Now, generally, who's going to pick out the title company will be the attorney for the seller generally. And then Section 10, the next bullet, prohibits lenders from requiring excessive escrow account deposits. A lender cannot go and hold 10 months worth of property taxes if they were just paid recently. They just don't want them to take advantage or gouge any potential buyers or anything else like that. It has to be reasonable. Usually they hold 2 months worth in addition to what might be due. Let's go on to page 135. Special information booklet. You can highlight that. Whenever anyone applies for the loan, HUD provided this. It's a 32-page booklet that explains everything about the closing and the cost. And this has to be given to the buyer when he applies for the loan. And lenders do make sure that they do provide this special information booklet. Now, also highlight, put X by the next paragraph where it says good faith estimate. Now, within 3 days of the loan application, the lender will provide a good faith estimate based on their initial earnest money, how much additional money they need to come in with to close that transaction. And they said they have 3 days to do it, but most lenders will give it on the day that they apply for the loan. Not only how much additional money they have to come in with, what their monthly payments are going to be, including taxes, insurance, that PITI, principal, interest, taxes, and insurance. Now, on the good faith estimate, I'd like you to highlight, put an X by the next 3 bullets here, to make sure that borrowers are not ripped off or anything. They have what they call these tolerances. So that first bullet that says there's no tolerance, meaning that these fees cannot increase before the closing once they do the good faith estimate. which includes lender's charge for taking, underwriting, and processing the loan application, including points, loan origination fee, and yield spread premiums. There's a 10%, the second bullet, tolerance. These fees cannot increase by more than 10%. They're talking about settlement services, and also the next bullet, the title services and the title insurance. And then unlimited tolerance, because they have no control over this, and it could be what the homeowner's insurance is going to be, what the property taxes are going to be. There's no unlimited tolerance because they can't control that. So let's go on now to page 136. About the middle where they talk about kickback and referral fees, you can highlight that also and put X by it. Again, RESPA prohibits the payment of kickbacks or unearned fees on any real estate settlement service. It prohibits referral fees when no services are rendered. They just don't want people taking advantage of others, like borrowers or sellers either. Now, the next paragraph, TILA RESPA Integrated Disclosure Rule. This is a fairly new rule that came up because of the problems they had going back to 2006, 2007. TILA, Truth in Lending Act, RESPA Integrated Disclosure Rule. This happened in 2010, was passed by Congress. Federal legislation known as the Dodd-Frank, you don't have to memorize the senators on that. Dodd-Frank Wall Street Reform and Consumer Protection Act says that was created to protect the consumer and gives more transparency on the loan process. Does not apply to transactions, only for if there's a bank involved in the transaction. So, but a lot of this refers to your lender. Your lender will be the ones that have to follow this rule, but just want you to be aware of it. Now, let's go on to page 137. In the middle of the page where it says loan application procedure, it says in a normal loan application procedure, the creditor, the borrower, fills out the worksheet provided by the lender to facilitate analysis of the creditor's ability to qualify for the loan. See, the bank wants to make sure that the borrower can afford to buy the loan. They do not want to foreclose. It costs a bank money to foreclose. A bank makes their money by the borrower making their payments each and every single month, and they want to make sure that they are qualified for that. Some information needed to apply under the TILA rules. You could go over these on yourself, 1 through number 6. Okay. Now, let's go on to page 138. The very bottom, the very last paragraph of page 138. I'd like you to highlight and put an X by that. Let me read some of this to you. A typical real estate transaction requires the accounting of the expenses incurred by either party, generally on what's called the HUD-1 form, the very last document signed by both the buyer and the seller. And it's required on any federally related transaction where there's a bank involved. All expenses must be itemized to arrive at an exact amount of cash required from the buyer and the net proceeds to the seller. These include prorated items, which we're going to be talking about very, very soon. So on the next several pages, they have examples of the closing documents. And if you want to go over that, that's fine. That kind of shows the expenses, how they're divided between the buyer and the seller. But I'm going to give you a moment. We're going to go to, I want to go to page 149. Let's go to page 149 of your textbook. On top of page 149, how the closing statement works. The completion of a closing statement involves the accounting of the parties' debits and credits. A debit is the amount that the party owes and must pay at closing. A credit's amount entered in a person's favor, amount that's already been paid, amount being reimbursed, or amount that the buyer promised in the form of a loan. Highlight, put an X by the next two lines. They're already in bold. A debit is amount to be paid by the buyer or the seller. A credit is amount payable to the buyer or the seller. So let's go on to my chalkboard here. I'm going to go over. I want to just make sure you're clear on this. I want to explain this to you. Okay, it's up. Okay, in a real estate transaction, of course, we have sellers and we have a buyers. We also have debits and credits. We have credits. Now, a debit to the seller means that they're going to wind up with less money at the closing. That's what a debit means to the seller. A debit to the buyer means that on the way to the closing, day before the closing, they had to go to the bank and bring in more money to the closing. Now, a credit to the seller means at the closing, the seller is going to wind up with more money. A credit to the buyer means that you bring in less money. So basically, if you look at this, debits, see, because they cost money, those are bad, and credits are good. Basically, that's what that means. Now, on these next few pages, the next 1, 2, 3 pages, you could go over those on your own, but I want to go over a couple of things with you. I am going to go to this next 3 pages, you can go on your own, but I want to tell you something. We're going to wind up on page 151 in a moment. Now, a couple of things I want you to know, and those are in the last few pages. I want you to read those on your own because they give you examples of some things that they're going to ask you. For example, the purchase price of the property. The purchase price of the property on the RESPA form is going to show up as a credit to the seller and a debit to the buyer. That makes sense to you. It should. So the purchase price shows up as a credit to the seller, a debit to the buyer. Now, let's say the seller is paying the commission, the entire commission. Well, that's going to show up on a statement as a debit to the seller if the seller's paying the commission. The earnest money, the money put up by the buyer at the time that the offer is made, is going to show up as a credit to the buyer. Doesn't mean anything to the seller. Now, here's something that a lot of people get mixed up on. The money that the buyer receives from the bank at the closing actually shows up as a credit to the buyer. The money that the buyer receives from the bank shows up as a credit to the buyer. I mean, they have to pay it back. That's the debit. Well, it shows up on the closing documents as a credit because that's money that they receive. So on those last few pages, you could go over those and look those over and decide. Make sure you understand a few of them. If you have any questions, you can always ask your instructor. Now, on page 151, also in the middle of the page where it says proration, I like you to highlight and put an X by that paragraph there. It says most closings involve the division of financial responsibility between the buyer and the seller for such items as loan interest, taxes, rents, fuel, utility bills. These allowances are called prorations. Prorations are necessary to ensure that the expenses are divided fairly between the seller and the buyer. Highlight, put an X by the next paragraph. Accrued items. These are accumulated items. Accrued items like water bills, taxes, interest on assumed mortgages that are paid in arrears, are expenses be prorated, are owed by the seller, will later be paid by the buyer. Therefore, the seller pays for these items by giving the buyer's credit for them at the closing. Then the buyer's going to have to pay for them when they receive these bills. prepaid items will include things like fuel, oil, and tanks, maybe assessments on a condo. These are expenses to be prorated that have been prepaid by the seller, not fully used up. And therefore now they show up as credits to the seller. Now, as far as prorations are concerned, let's go to page 152. At the very top, using this general principle, there are two methods of calculating proration. I do want you to highlight, put an X by the first bullet. Most cases, this is what's going to happen. What you need to know that there are 360 days in a year. This is called a banker's year. Each and every month, it's called the statutory month, contains exactly 30 days. January has 30 days. February has 30 days. Each and every month has 30 days. I want you to use the 30-day month, 360-day year on all your proration problems, unless, which happens occasionally, but very rarely, they're going to ask you to use the actual number of days in a year. So, in fact, if you skip down a little bit where it says in Bolden, Illinois, about a quarter of the way down, we use the following calculated proration: standard year of 360 days, standard month has 30 days. That's what I need you to know. Now, I am going to give you a couple proration problems for you. Let me clear up my board over here. And these are going to be very similar to things you will see. Just erase everything. Let me give you a couple of proration problems. Okay. Now let's say the property taxes these are the property taxes. They come out to $7,200 a year. Now the taxes were paid 1/1/2022 to 12/31. Even I put on 31, it's 30 days in every month on the proration problems. 2022. Our closing occurred on a closing date, happened on May 20th, 2023. Now, the taxes, I know taxes come out June 1st and September 1st of the following year, but it has nothing to do with the proration problem. So the question is, who's going to owe for the taxes? Does the buyer owe the seller, or the seller owes the buyer? Now, the buyer has lived on the house, and now day of closing, by the way, seller pays for the day of closing. If someone's renting an apartment, which I'm going to give you an example of that problem very shortly, the day of moving, the tenant's responsible for that. So the taxes were paid to the end of 2022. Nothing has been paid in 2023. So we're going to have to figure out who's going to owe for the property taxes. Now, the seller paid to the end of 2022, and I want to make this clear. So he's lived there from January 1st to May 20th, 2023, and he didn't pay any taxes. So the seller's going to owe the buyer for the taxes. Because in 10 days from that date, on June 1st, the new buyer is going to receive a tax bill, but that tax bill is going to be for last year. So, well, which were already paid. Now, Remember, the day of closing, seller's responsible for the day of closing. So let's figure out this problem. So the taxes are $7,200 a year. Divide that by 12 months. And that's going to equal $600 a month. Now, the seller's going to owe from January 1st of 2023 to May 20th of 2023. Question is, how many months and how many days does the seller owe the buyer for? Now, this is sometimes, I want to make this clear. So if you have to count on your fingers, count on your fingers. January of 2023 is 1 month. February, March, April. The end of April is 4 full months. So the buyer's going to, the seller's going to owe the buyer for 4 months and 20 days. Please make sure you understand that. A lot of people will put in 5 months because they think we're in the 5th month. 5 months and 20 days. And there's an answer for that, but that's going to be wrong. January, February, March, April, the end of April is 4 full months. We're only 20 days into May. So $600 a month times 4 months. January to the end of April. That comes out to $2,400 for the first 4 months. Now we have to figure out the 20 days of May. So it's $600 a month. Divided by 30 days in each and every month. Each and every month has 30 days. And that's going to equal $20 a day. Times 20 days. From May 1st to May 20th. Times 20 days. And that equals $400. Now we add the 400 for the 20 days of May to the 2,400, and we get $2,800. Question to you. Who owes that $2,800? Does the buyer owe the seller, or the seller owes the buyer? Seller owes the buyer. Seller has occupied that property, seller owes the buyer for it. Now, let me give you another problem, proration problem. Now remember, the day of closing, seller is responsible for day of closing. Tenant, they are responsible up to including the day they move out. Now let's say the rent on the apartment comes out to $1,860 a month. Okay, $1,860 a month. Now, on October 1st, the landlord came knocking on the door of the tenant to pick up the rent for the month of October. But the tenant says, look, I'm moving out. I'm leaving on October 22nd. So here's what the landlord said. Remember, this is like on a state exam. That's okay. Just pay me for the 22 days you're going to be here. So the question is, how much rent did the landlord collect? So what you do is you take that 1860, I'm sorry, 1860, 1,860. Let me get my numbers right here. You divide it by 30 days. Okay, because every month has 30 days. Which is going to equal $62 a day. times 22 days, times 22 days. And that comes out to total $1,364. And this is what the tenant's gonna owe the landlord for 22 days in October. Every month has 30 days. Even October has 30 days. So those are just a couple of examples of some proration problem. And that actually is the end of chapter number 10. They got a couple other examples here on page 154, 155. I'd like you to go over those too. Again, if you have any questions on this, you can always ask your instructor. So this is the end of chapter 10. I'm looking forward to seeing you in the next few videos coming up. And if you have any questions, always talk to your instructor. And don't forget, keep up with the chapter quizzes. You cannot take the state exam unless you complete the courses and you completed all the chapter quizzes. So again, this is Sam Zakarian saying goodbye for now. I will see you in the very next video. Thank you.